Welcome back to the deep dive. Today, we are opening a file that, honestly, it feels less like a corporate earnings report and more like the script of a disaster movie for the financial sector. But this is very real, and it is happening right now.
It's intensely real.
Yeah.
And for anyone paying attention to the machinery of the American healthcare system, the alarm bells aren't just ringing, they are absolutely screaming.
So let's set the scene. The date is Tuesday, January 27, 2026. If you've looked at a stock ticker today, you probably did a double take.
Oh, for sure.
You might have even refreshed your browser thinking it was some kind of a glitch. UnitedHealth Group ticker symbol, UNH, the company that is supposed to be the steady ship, the blue chip giant that you buy, hold, and sleep soundly on.
The bedrock.
Exactly. Well, that ship is taking on water fast. The stock plunged approximately 19% in a single day.
Which, just to put some context on that for a second, is just astronomical for a company of this size.
Yeah.
We are talking about a company that, until yesterday, was one of the largest corporations on Earth.
Yeah.
A 19% drop wipes out tens of billions of dollars in market value in, like, the blink of an eye. It's a kind of volatility you expect from a crypto coin, not the backbone of the U.S. healthcare system.
That's a perfect way to put it. And usually when we see a drop like that, it's because of one specific thing. A bad earnings call, a scandal, a missed number.
Something singular.
Yeah, but looking at the massive stack of documents you've brought to the table today, the earnings transcripts, the White House fact sheets, the CMS proposals, this feels different. This doesn't feel like a stumble. This feels like a fundamental stress test of the entire managed care business model.
That is the perfect way to frame it. This is a stress test, and right now the bridge is shaking. We are witnessing a collision of two massive forces. We've been calling it the double whammy.
Okay, the double whammy. Let's break that down. What are the two trains colliding here?
Okay, so train number one is internal. It's coming from inside the house. UnitedHealth just reported what we call a kitchen sink quarter for Q4 2025.
The kitchen sink.
They threw everything in. They took a massive $1.6 billion charge to just clean house. And on top of that, their medical costs are just soaring. They're bleeding cash internally in ways they haven't in decades.
Okay, that's train one. What's train number two?
Train number two is an external siege. I mean, the political environment has completely shifted under their feet. You have the Trump administration's new great healthcare plan, which is openly, hostile to the traditional insurance model.
Right.
And then, as if that weren't enough, you have the Centers for Medicare and Medicaid Services, CMS, dropping a reimbursement proposal that has absolutely shocked Wall Street, a 0.09% increase.
0.09, which, with inflation where it is basically a cut.
It's a massive cut. It's not even a question. So you have internal bleeding meets external suffocation.
So our mission for this deep dive is to decode the result of this collision. Because UnitedHealth is pivoting to a strategy they are calling shrink to grow.
Shrink to grow.
That sounds like the ultimate corporate oxymoron. I mean, companies are built to get bigger, right? Shrink to grow just sounds like code for we are losing customers and we don't know how to stop it.
Well, it's actually more calculated than that. It means they are planning to voluntarily shed millions of customers in 2026.
That is just wild. The largest healthcare company in the U.S. is effectively putting up a closed sign for millions of people. We need to understand why. So is this a temporary stumble? Or is this, an existential crisis for the entire industry?
To answer that, we have to start by understanding the beast itself. We have to look at the anatomy of a giant. Because I think most people hear UnitedHealth, and they just think about the insurance card in their wallet.
Sure. They think insurance company, blue card, white lettering, that's it.
But calling UnitedHealth just an insurance company is like calling Amazon just a bookstore. It completely misses the entire point of the business model.
Okay, let's unpack that anatomy. Because looking at their revenue mix, this really is a two-headed monster.
It is. And you have to understand both of these heads to get why they're in so much trouble. So head number one is the one we all know, UnitedHealthcare. That's the insurance arm. As of 2025, they served 49.8 million consumers.
49.8 million, that is the population of Spain.
It's massive. And crucially, they are the 800-pound gorilla in Medicare Advantage. They hold about 29% of that market. So almost 1 in 3 seniors who have a private Medicare plan are with United.
And that's key. That exposure is why the government's rate decision hurts them so badly.
It's their biggest vulnerability right now.
Okay, so that's the insurance side. They collect premiums, they pay claims. Pretty straightforward. What is the second head?
The second head is the engine under the hood, the part most people don't see. That is Optum.
Optum always confuses people. I see the logo on buildings, I see it on prescriptions, but what is it?
Think of Optum as the everything else of healthcare. It's the health services arm. But it's not small. It is a giant in its own right.
Yeah.
And Optum itself is divided into three main parts.
Okay.
First, you've got Optum Health. This is actual care delivery. We're talking about doctors, urgent care clinics, surgery centers. They are the largest employer of physicians in the entire country.
Wait, hold on. So the insurance company employs the doctor.
Correct. Keep that in mind. It's critical. Then you have Optum Rx. That's their pharmacy benefit manager, or PBM. They're the ones negotiating drug prices and handling the whole pharmacy side of things.
Got it.
And finally, you have Optum Insight, which is the data, the analytics, and the technology side, the brains of the operation.
Okay, let me try to stitch this together then. UnitedHealth insures me, so I pay them a premium every month. Then I get sick. I go to a doctor who, it turns out, works for Optum Health.
Right.
United then pays Optum for that visit. Then the doctor prescribes a drug, which is managed by Optum Rx. United pays Optum again. And all that data is processed and analyzed by Optum Insight.
You've got it. As a closed ecosystem, they call it the vertical integration flywheel. The entire strategy is to control the whole healthcare dollar from start to finish.
It sounds like a walled garden, like the Apple ecosystem. Once you're in, they monetize every single interaction.
That's the perfect analogy. In a traditional model, an insurer takes your premium and then pays it out to independent hospitals, independent pharmacies. The money leaves the building.
Sure.
In the United model, the money stays in the house. It just moves from the left pocket, which is UnitedHealthcare, to the right pocket, which is Optum.
Which sounds like a license to print money. I mean, how could that possibly go wrong?
It works beautifully when funding is flowing. When the government turns on the tap and the money is coming in, that flywheel spins and they capture a little bit of margin at every single step. But, and this is the absolute crux of today's deep dive, that model has a fatal flaw. It breaks down completely when the government turns off the tap.
And that brings us right to the kitchen sink quarter, Q4 2025. You mentioned they took a huge charge. Let's look at the financials, because this is where the cracks in that flywheel really started to show.
The headline numbers were rough. Q4 revenue came in at about $113.2 billion. That was a miss by around $520 million. Now, in the grand scheme of things, for a company this size, $500 million is almost a rounding error.
Right, but it's the signal it sends.
It's the signal. It sent a signal of weakness.
And what about the earnings? The profit?
Well, adjusted EPS was $2.11, which is in line with what Wall Street expected. But if you look at the GAAP earnings, the real unadjusted numbers, they were crushed. And that's because of this $1.6 billion net of tax charge.
$1.6 billion. That is a lot of money to just write off. They called it cleaning house. What does that mean? What exactly were they cleaning?
They wanted to get all the bad news, all the skeletons out of the closet before 2026 started. It really breaks down into three buckets. First, a whopping $2.5 billion pre-tax for restructuring.
Restructuring, that's corporate speak for firing people and closing offices.
Precisely. Workforce reductions and what they call real estate rationalization. They are shrinking their physical footprint. Then you have about $800 million. This is the final cleanup cost from the Change Healthcare cyber attack.
Oh, wow. That was back in 2024. The ghost of that hack is still haunting them.
It lingers. This covers loan reserves and bad debt associated with that hack. I mean, it paralyzed the healthcare payment system for weeks, and they are still paying the bills for that cleanup.
Okay, so that's two buckets. What's the third?
The third bucket is the most interesting one, strategically. They put aside $625 million for a reserve for lost contracts in Optum.
Lost contracts? That sounds ominous. What is that?
It means they signed deals, mostly on the care delivery side, with Optum Health that are structurally unprofitable. They're losing money on every single patient in those contracts.
So they signed bad deals.
They made bad bets. But because of the legal terms, they can't actually exit those contracts until after 2026. So they're booking the loss now. They're basically admitting, we messed up, we're paying for it today, so you don't have to talk about it next year.
So they're clearing the decks. But the financial pain didn't stop at that charge. The scariest number for investors, the one I saw everywhere in the report, was the MCR. I saw this acronym everywhere, MCR. Break that down for us. Why does Wall Street obsess over this one number?
MCR stands for medical cost ratio, and it is the single most critical metric for any health insurer. It's really simple. It measures how much of every premium dollar goes to paying for actual medical care.
Okay, simple enough.
In 2024, United's MCR was 85.5%. So that means for every dollar they took in premiums, they spent 85.5 cents on doctor visits, hospital stays, drugs, and so on.
Which leaves about 14.5 cents for everything else.
Exactly. For overhead, salaries, marketing, technology, and of course profit. That was a healthy margin for the industry.
Okay, so what happened in 2025?
In 2025, that number spiked to 89.1%.
Whoa, so they are spending almost 90 cents on the dollar just on care. That profit margin is getting squeezed to death.
It is evaporating. When you have an MCR near 90%, you have zero room for error. A bad flu season, a new expensive drug, one small thing goes wrong, and you are suddenly underwater.
What caused that spike? I mean, did people just suddenly get that much sicker in 2025?
It's a combination of things. First, utilization is elevated. People are, going to the doctor more than expected, maybe catching up on care they deferred. But there's a specific regulatory change that I want to highlight because it shows just how sensitive this business is to government rules. It's called the 2 midnight rule.
The 2 midnight rule, it sounds like a curfew for teenagers.
Lapses. It feels like one for their accountants, I'm sure. Here's how it works. For years, there was this gray area in hospitals. A senior comes in, maybe they had a fall or they feel faint. The hospital keeps them overnight to monitor them. The insurer would classify that as observation.
Observation, okay.
Observation is billed at an hourly rate. It's relatively cheap. But under new regulatory enforcement, if that patient stays in the hospital across 2 midnights, so, roughly 24 to 48 hours, the insurer must classify it as an inpatient admission.
And what's the difference in cost?
Oh, the difference is massive. Inpatient is billed by the DRG, the diagnosis code. It's a flat, large fee. It is significantly more expensive than observation. So basically, the government forced UnitedHealth to upgrade thousands of patients from the Motel 6 rate to the Four Seasons penthouse rate.
And United just has to eat that cost.
They just have to eat it. And that, right there, drove the MCR up. You add in higher physician fees, doctors are demanding more money, and you have a perfect recipe for margin destruction.
So that's the internal pressure. The ship is leaking from the inside. The flywheel is jamming up. But now let's talk about the storm that was brewing outside. Because while they were dealing with their own balance sheet, the political environment shifted dramatically.
And this is the Trump effect. This is what we're calling the regulatory siege.
It really does feel like a siege. And the first shot was fired on Monday, January 26, 2026, the day before their earnings call.
Perfect timing. So CMS, under the Trump administration, released what's called the advance notice for 2027 rates. Now, usually Wall Street expects a nice little bump to cover inflation and rising costs.
Sure.
Inflation is running, 3%? Medical inflation is usually even higher. So they were looking for a 4% to 6% increase in payments to insurers.
4 to 6%. That keeps the lights on, keeps the model working.
The actual number that CMS proposed, a net average payment increase of 0.09%.
0.09.
Less than 1/10 of 1%.
That's basically zero. That's a rounding error.
It is essentially flat. And when you factor in that their medical costs, like those physician fees and the 2 midnight rule, are rising at like 8% or 10% a year, a 0.09% revenue increase is effectively a massive, massive funding cut. It is a starvation diet.
Why would they do that? I mean, Dr. Oz is the CMS administrator now, right? What is his justification for basically choking off the entire insurance industry?
Well, Dr. Oz came out and he defended it as modernizing risk adjustment. His stance, and really the entire administration's stance, is that they are protecting taxpayers from what they see as unnecessary spending. The argument is that these big insurers have been gaming the risk adjustment system for years.
Gaming it how? What does that mean?
By making patients look sicker on paper than they actually are. They find and document every possible diagnosis to trigger higher payments from the government. The administration is essentially saying, the party is over. We are correcting the math.
So it's a crackdown, a major crackdown.
It is. And UnitedHealth's management, on their call, they called the rate disappointing and warned that it completely ignores the reality of medical cost trends. I mean, they're screaming from the rooftops. Our costs are going up 10%. You can't give it 0%.
But it's not just the rates. That was just one part of the siege. We also have to talk about this great healthcare plan that President Trump released on January 15th. This document isn't just a rate adjustment. It's a whole philosophical shift.
It is a total rewrite of the social contract when it comes to healthcare. The core philosophy of the great healthcare plan is, simply put, to bypass insurers.
Bypass them.
The White House explicitly said, and I'm quoting the fact sheet here, They want to stop sending billions in extra taxpayer-funded subsidies to big insurance companies.
So where does the money go? If you don't pay the insurer, who do you pay?
You pay the patient. The proposal is to send direct subsidies to consumers or to put that money directly into health savings accounts, HSAs, and then you let the consumer go out and buy a plan on the open market.
That shifts the power dynamic completely. Instead of the government writing one giant check to UnitedHealth, they're writing millions of small checks to individual people.
Exactly. It turns the patient into a shopper, a retail customer. And to help them shop, there's this new plain English standard.
I read about this. It sounds almost punitive in how aggressive it is.
It is aggressive transparency. The plan requires insurers to publish coverage comparisons without any jargon, which sounds good.
Yeah.
But more importantly, they have to prominently post their profit margins. They have to disclose the percentage of revenue paid out in claims versus their overhead.
Okay.
And, this is the real kicker, they have to publish their claim denial rates prominently.
Wow. So if you're UnitedHealth and you deny, say, 15% of claims, you have to put that number right on the front page of your website.
Exactly. Imagine going to a car dealership and there's a giant sign on the door that says, just so you know, we deny 15% of all warranty claims. Would you buy that car?
No way. You'd run out of there.
It's designed to shame them into compliance and to give consumers ammunition to shop around. It basically commoditizes the insurance product and makes them compete on things they'd rather not talk about.
And I see they're also going right after the PBMs, the OptumRx side of the house.
Yes. The plan aims to end what it calls kickbacks paid by PBMs. We talked about how OptumRx negotiates drug prices. Traditionally, they get to keep a portion of the rebate from the drug manufacturer. The administration calls that a kickback. They want to ban it entirely. That strikes directly at the heart of Optum's profitability.
So you've got the rate cut, the radical transparency rules, the direct subsidies, and then there's the final piece of the puzzle, the ACA subsidy cliff. That happened on January 1st, right?
Yes. The enhanced premium tax credits, the things that made Obamacare affordable for millions of people for years, they expired on January 1st, 2026.
And what was the immediate impact of that?
Instantaneous chaos. 22 million Americans faced an average of a 114% premium spike overnight.
114%. So if my bill was $200 a month, it's now over $400.
More than doubled. And naturally, when prices more than double, people walk away. Enrollment in ACA plans dropped by nearly 1 million people immediately. They were just priced out of the market.
Okay, so let's just pause and survey the battlefield here. UnitedHealth is bleeding money internally from bad contracts and high costs. At the same time, the government just told them no more raises. And actually, we're going to make you tell everyone how much money you keep. And also, we're cutting off the subsidies that help your customers afford your product.
It is the definition of a perfect storm. There's no escape.
So what do they do? How do you respond to that? This brings us to the core of this whole deep dive. The strategy pivot. Shrink to grow.
This is the part that fascinates me as a business analyst. Because for the first time in nearly 40 years, UnitedHealth is projecting a revenue decline.
A decline. They are actively planning to get smaller.
They guided their 2026 revenue to be roughly $439 billion. Now that sounds like a lot of money, and it is, but it represents about a 2% drop from 2025. This company has been a growth machine for decades. To see a minus sign in front of their revenue growth is just shocking.
And this is voluntary, right? This is the key. They aren't shrinking because they can't find customers. They are shrinking because they don't want certain customers anymore.
That is exactly right. The new mantra inside the company is margin over volume. They have realized that in this new environment with the 0.09% rate and the high costs growth is actually toxic.
Toxic growth. Explain that concept.
Usually in business, you want more customers. It's simple. But if every new customer costs you $1.05 to treat and you only get paid $1 in premium from the government, well, the more you grow, the faster you go bankrupt. UnitedHealth has done the math and realized that millions of their current members are unprofitable.
So they're shedding them. Who are they cutting loose?
It's the seniors. In Medicare Advantage, their biggest business, they are planning to lose between 1.3 and 1.4 million members in 2026.
Wait, 1.4 million seniors? That's a massive chunk of the population. That's bigger than the entire city of Dallas.
It is. And the reason is simple, brutal math. The rates from the government are flat. Their costs are trending up at 10%. These specific members, maybe they're in rural areas with expensive doctors, maybe they have complex chronic conditions, are currently unprofitable. UnitedHealth is saying, we cannot afford to insure you under these terms.
So Where do those people go?
That is the million-dollar, or I guess the billion-dollar question. They will have to scramble to find other plans. But if UnitedHealth, the biggest, most efficient player in the game, can't make money on them, who can? They might end up on plans with worse benefits, narrower networks, or much higher out-of-pocket costs.
And it's not just seniors, is it? They are cutting back on the commercial side, too.
Right. They expect to lose over 500,000 members in the commercial exchange, the ACA plans.
Why are they exiting that market?
The margins are just razor thin. We're talking about 1% margins if they're lucky.
Yeah.
It's just not worth the risk and the headache, especially with the subsidy cliff causing so much volatility.
And I saw they made a really interesting PR move related to this.
Oh, it was a brilliant strategic move to deflect political heat. They pledged to voluntarily rebate all of their ACA market profits back to customers in 2026.
Wait, they're just giving the money back? That does not sound like an insurance company.
It's a genius PR move. Think about it. They're being accused of being greedy middlemen. So they just stand up and say, fine, we will cap our profit at zero. We will give back every single penny of profit we make on Obamacare.
So they can't be attacked for profiteering because there are no profits.
Exactly. It completely defuses the political bomb. It allows them to exit the unprofitable parts of the market without looking like the villain while they quietly shed the risk.
And what about Medicaid?
They're losing members there too. Somewhere between 565,000 and 715,000 members. This is mostly due to state funding shortfalls. States are running out of money, so they're kicking people off the rolls or redefining eligibility. UnitedHealth is just losing those contracts as the states cut back.
So across the board, Medicare, commercial, Medicaid, they are shedding millions of lives, shrink to grow. It is a defensive crouch. They're just hunkering down to survive the storm.
But shrinking the insurance pool is only half the battle. Yeah. Remember the other head of the monster? The engine room.
Optum.
They have to fix the engine too. And this is section 5 of our deep dive. Re-engineering Optum. Because, shockingly, Optum Health's operating earnings were actually negative in Q4 2025. They lost money.
They lost money delivering care. How is that possible? I thought the care delivery side was the stable part. People always get sick.
It was supposed to be.
Yeah.
But they got caught in a trap. They took on what they are now calling unaligned risk contracts.
Unaligned risk. Unpack that corporate speak for me.
Okay, imagine you're a general contractor building a house. You agree to a fixed price with the homeowner. You say, I'll build this house for $500,000. But here's the catch. You don't have control over your subcontractors. You can't tell the plumber which pipes to use. You can't tell the electrician how many hours to work.
That's a recipe for absolute disaster. The plumber is going to install solid gold pipes and bill you for it.
Exactly. That is unaligned risk. Optum took on the financial risk for patients. They agreed to the fixed price from the insurer. But they didn't control the doctors or the clinics those patients were actually visiting. They had all the responsibility with none of the authority.
And that failed spectacularly.
It failed miserably. So the new strategy for 2026 is back to basics. They are shedding those unaligned contracts as fast as they can. They are saying, we will only take financial risk in markets where we own the delivery system, where we employ the doctors, where we own the clinics.
Total control. If we're paying the bill, we want to be the boss.
Correct. And speaking of control, there is a major reorganization happening that really highlights their vision for the future. In 2026, Optum Financial Services is being moved under Optum Insight.
So they're moving the bank into the data center. Why are they doing that?
The vision is to create a closed-loop system. Think about how healthcare payments work right now. It is an absolute nightmare.
It's terrible.
You go to the doctor, you leave. 3 weeks later, you get a confusing bill in the mail. You call your insurance. They say it's denied. You have to appeal. It's all post-service reconciliation. It's just chasing money after the fact.
It's inefficient and everyone hates it. The patient, the doctor, everyone.
So UnitedHealth wants to move to real-time point-of-care approval.
Okay, what would that look like in practice?
Because Optum Insight has all the data on your policy and your clinical history, and Optum Financial has the banking rails. Imagine this.
Yeah.
You walk into the doctor's office, you swipe your insurance card at the front desk, the system instantly checks your coverage, checks the doctor's contract, approves the procedure, and pays the doctor before you even walk into the exam room.
So the doctor gets paid instantly?
Instantly. And you, the patient, know exactly what you owe instantly. No more surprise bill in the mail 3 months later.
That would be revolutionary. I mean, that would change everything.
It reduces administrative friction and waste, which save huge amounts of money. And in a year where every single penny counts, that kind of efficiency is gold.
Is there any bright spot in the Optum universe right now, or is it all just restructuring and fixing broken pipes?
Actually, yes. OptumRx, the pharmacy side, is the star performer. They won 800 new clients for the 2026 selling season.
800 new clients is huge. How did they manage that when the Trump administration is actively attacking PBMs and calling them out?
By embracing the very thing that threatens them, transparency. They are aggressively pushing a new model where they pass through 100% of rebates directly to customers.
So they aren't keeping the so-called kickbacks.
Right. They're going to their clients and saying, we will give you all the savings. Our fee will be a simple, flat administrative fee. And it's working. 95% of their customers have opted for this new model.
It's a defensive move.
It's totally a defensive move. If you give the rebates back voluntarily, it's much harder for the government to sue you for keeping them. They're getting ahead of the regulation.
Smart. Pivot before you are forced to pivot. And I saw something about them changing rules for prior authorizations too.
Yes. They removed prior authorization requirements for 180 different drugs.
Which removes a huge point of friction. Doctors hate prior auth. Patients hate it. It's a universal pain point.
Exactly. It reduces the administrative burden, which, again, cuts costs and makes them easier to work with.
Okay, so we have the shrink strategy on the insurance side, the Optum fix on the services side. But if revenue is actually going down, how are they promising earnings per share of $17.75? Usually if you sell less stuff, you make less money.
That brings us to our next section, the efficiency engine. If you can't grow the top line, the only other lever you have is to slash your expenses. They are targeting $1 billion in operating cost reductions in 2026.
$1 billion in cuts. Where does that come from? It can't all be from layoffs.
AI and automation.
Of course. It's 2026. The answer is always AI.
But for them, it's not just a buzzword. It's real and it's at scale. They reported on their call that 80% of member calls now leverage AI tools to assist the advocates.
So when I call UnitedHealth Group, am I talking to a robot?
Not necessarily. You might be talking to a human, but that human has an AI whispering in their ear, pulling up your file instantly, suggesting the correct answer, maybe even drafting the follow-up email for them. Or, for simple things like checking a claim status, yeah, the AI handles the whole interaction from start to finish.
Which means they need fewer humans to answer the phones.
Exactly. They're using AI to answer questions faster and to dramatically reduce the headcount needed for member support. They're replacing lost revenue with newfound efficiency. It's a harsh calculation, but it's the only way they can hit that earnings target.
And they are also using this transparency offensive we talked about earlier as a cost-saving measure.
Yes. By releasing independent reviews of their business practices, like how they handled prior auth and claim approvals, they're trying to rebuild trust so the regulators back off. It's much cheaper to be transparent than to be under a constant state of investigation.
So, putting this all together, we have a giant that is shrinking, cutting costs, pivoting to AI, and fighting a war on Washington's front. For the listener who is maybe an investor or just has a 401k with UNH stock in it, is this stock a falling knife? Or is it a bargain?
It's the classic value trap question, isn't it?
Mm-hmm.
Right now, the valuation is completely disconnected from its history. UNH is trading at about 16 to 17 times earnings.
And what do they usually trade at? What's the historical average?
Historically, they trade around 23 times earnings. So on paper, it looks incredibly cheap.
But cheap can be dangerous. The stock is often cheap for a reason.
Right. The market is pricing in a broken growth story. The market is saying, we don't believe you can grow anymore. Investors are absolutely terrified of the regulatory environment.
But they did raise the dividend, right? That's usually a sign of confidence.
They did. They raised it by 5.2%. The yield is now around 2.8%.
Yeah.
That puts a bit of a floor into the stock. It literally pays you to wait and see what happens.
Mm-hmm.
And technically, analysts are seeing a strong support level near $270 a share.
So if it drops to $270, a lot of buyers might step in.
That's the theory. They also paused their stock buybacks. They're using all their cash to pay down debt instead. They want to get their debt-to-capital ratio back down to a very conservative 40%. They're playing it safe, shoring up the balance sheet.
But there's a date circled on everyone's calendar, April 6th, 2026.
That is the binary event. That is the day CMS releases the final rate announcement for 2027.
This is the final verdict on that 0.09% proposal.
Exactly. It's a huge gamble. If the rate stays at 0.09% or close to it,
Yeah.
UnitedHealth has already said they will have to cut benefits further. The stock could take another big hit. But if the lobbying works, and you have to remember, they have the best and most powerful lobbyists in D.C., and that rate moves up to maybe 1.5% or
The
2%,
stock could rally hard.
it could be a massive relief rally. The sigh of relief would be heard all over Wall Street. But until April 6th, the stock is likely stuck in what we're calling the penalty box.
The penalty box. I like that analogy. It's a transition year. They're just taking their time out, serving their penalty.
They are. The strategy for 2026 is clearly defined, risk defined, portfolio protected. They aren't trying to win the Super Bowl this year. They are just trying not to get relegated to a lower division.
It really challenges that whole idea of too big to fail, doesn't it?
It absolutely does. They are proving that even the biggest, most powerful player has to bow to the reality of government funding. When the sovereign, your biggest customer, changes the rules of the game, the giant has to kneel.
So as we wrap up this deep dive, we have unpacked a lot. The kitchen sink quarter, the Trump regulatory siege, the shrink to grow pivot, and the AI efficiency play.
It's a fascinating real-time case study in corporate survival.
But I want to leave our listeners with a final thought. We spent a lot of time today talking about billions of dollars in stock prices and MCRs, but let's bring it back to people. You mentioned that UnitedHealth is the most efficient, most integrated player in the entire game. They own the doctors, the drugs, the data.
They are the undisputed gold standard of efficiency in this space.
And even they, the gold standard, cannot make the math work for 1.4 million seniors without losing money.
That's the truly scary part of this whole story.
So here is the question for you to think about. If UnitedHealth is shrinking to survive the great healthcare plan, what happens to the smaller insurers? The ones who don't have an Optum to fall back on. The ones who don't have that scale.
They might simply collapse or be acquired for pennies on the dollar.
And more importantly, where do those 1.4 million seniors go? If the most efficient company in America can't afford to insure them, who can?
That is the question that should keep policymakers up at night. Are we inadvertently creating a whole class of uninsurable seniors?
Something to mull over. That's it for this deep dive into the UnitedHealth Reset. We'll be watching that ticker on April 6th. Thanks for listening.
Thanks, everyone.